Hello and welcome to Accounting 201. I'm your host, Dr. B. Today we're going to be talking about long-term fixed assets and depreciation. Real fun and interesting topics. Where are we in the course? We're currently in week 5. We've made it halfway. This is an 8-week course. Today we'll be covering chapters 9 and 10. Last week you had your midterm exam. The midterm exam, it was difficult for most. That is for sure. There were 10 questions that covered chapters 1 through 8. Some of those questions were very challenging. I know. The reason for the midterm exam and the final exam being challenging is the idea that we are measuring your understanding of the respective topics. For the questions that you got incorrect, that demonstrated questions that you had difficulty understanding that topic. So what do we do about that? What I'm going to do is I'm going to compile the data from each topic based off of the responses for each question. I will draw linear conclusions to then analyze the responses and start to create a worksheet that will help us to better understand where the problem areas are. And what that will do for you is I will provide you with a structured plan. And it also gives me an idea of where the problem spots are. Because not all the content is as easy as pie, right? There's certain parts that are very challenging. So that was the midterm. Your homework assignments, most of you have been very good about getting those in on time. Remember, it's very important that you get your homework in on time, whether that be discussion boards, whether that be your quizzes or your homework assignments in Cengage. It's all very critical that you get that in on time. Yep. Discussion boards cannot be made up, so you can't jump back in and start responding. It doesn't work that way, okay? The discussion boards, if you did not participate in the discussion boards, you lost 5% of your grade, okay? I mentioned that several times before, that you have to participate in all of the assignments. Not participating in discussion boards results in a reduction of 5% of your total grade. As you know, each assignment is worth 5% of your total grade. So if you don't participate in 2 discussion boards, you drop the full letter grade. If you partially participated, meaning you threw together a couple sentences, that's worth maybe 2 points, right? There is a rubric that you need to be following. A discussion is not just an original post; it's a post and 2 responses. That's a discussion. Discussion means a conversation between 2 or more people. Some of you still don't quite understand that part. So, and this isn't just me talking. You're going to have discussion boards and other courses at some point. So you need to understand how they work. You can't just throw an original post and expect to get full credit. It doesn't happen that way. If you have questions, please let me know. Okay, so I'll get off my soapbox. We're halfway through the semester. Let's make sure that we finish strong, okay? We have 4 weeks left, this week through week 8. So what does that mean? You'll have 8 more assignments plus your final exam. That all of it is already open and available. You can go all the way. You can work ahead as much as you want to. Keep trying those homework assignments. The homework assignments, you can do unlimited tries, right? So for the homework assignments in Cengage, unlimited tries. The quizzes, you can take those up to 2 times. If you're not satisfied with your grades on homework assignments or quizzes, homework assignments can be done unlimited tries, and quizzes can be done up to 2 times. So if you're not happy with a grade that you got on a homework assignment or quiz, redo it. Okay. And if you have questions on the questions, reach out to me. I'll be happy to help you out. Some of you were so kind enough to participate in the mid-semester survey. The mid-semester survey is open until the 14th. Where can you find it, you might ask? If you go into Module 2, Week 4, there's one called Mid-Semester Survey. Oh, and here's a fun thing. If you didn't do so well in the midterm, take the mid-semester survey. You get an extra 5 bonus points for completing it. Okay, 5 bonus points for completing the mid-semester survey. Oh, five bonus points, guess what? That's 5% of your total grade. So if you didn't participate in the discussion board or didn't do well in the midterm, I strongly recommend you participate in the mid-semester survey. What does the mid-semester survey do for you, you might be asking? Well, it provides me with your feedback. It's anonymous. I don't see your names, okay? All I see is you participated. I don't see your name. That's attached to the feedback, okay? So be brutally honest in the mid-semester survey. What does it do? It provides me with your feedback. I ask you, and I've asked you all before, what do you like? What don't you like? What do you want to see change? That's what this survey asks. What do you like? What don't you like? What do you want to see change? It's 5 questions, very open-ended. Be brutally honest, okay? One student, and I read through some of the responses already, one student mentioned that they want to see groups, and they want to see games, and they want to see, it's cool, yeah. There's a lot of really great ideas that you all have to help make this course even better, right? And so please take that survey. It'll really help me, and it'll really help you, because I will make adjustments to the way that I teach and the way the course is designed based off of your feedback, okay? And I mentioned that before. I take your feedback very, very seriously. My objective is to become a better professor and to have a better course for you, the students. So please, complete the mid-semester survey. You get 5 bonus points if you do it. Yay, 5 bonus points. Yeah, please do it, for sure. Okay, you can find that in Module 2, Week 4. It's right below the midterm. Yeah, please do it, please. It really helps. It'll help you, it'll help me. So, okay, sorry, I just had to point that out. Here we are, we're in Week 5. Right now we're going to discuss Chapter 9, then we'll jump into Chapter 10. This week you have a homework assignment, Cengage for Chapter 9, and a quiz on Blackboard Chapter 10. As always, all you got to do is just follow everything in sequence, one thing after another. Click on Chapter 9. Just as before, you'll see some, what you have to do. This particular one doesn't have any additional videos. I might try to get some in there. It's so for some topics they're hard to get. But just make sure you click on every single item. Yeah. You'll go through PowerPoint presentation. It's organized the same exact way as previous weeks. Just click on everything. Yeah. Okay. So we're in Week 5. We're going to do Chapter 9 right now, and then we'll jump into Chapter 10. As always, as you have questions, just unmute your mic and ask your question. That is really, really helpful. And I like your questions. They're fun. And oftentimes, if you have the question, your classmate also has the same question. Okay, let's rock and roll, shall we? Long-term assets. Long-term assets, as you know, are property, plant, and equipment. Property, plant, and equipment. Those are long-term fixed assets. We also have this thing called intangible assets. The word tangible means you could physically touch the asset. I can physically touch that building. I can physically touch the ground. I can physically touch the equipment. Okay. Then there's intangible assets. These would include things like copyright, Intellectual property. Those are ideas. I can't physically touch an idea. Okay. Copyrights. I can't physically touch a copyright. A trademark, a logo. These are intangible assets. They hold value, but I cannot physically touch them. We'll talk more about it. And that's what this chapter focuses on, are fixed assets, intangible assets, and how we depreciate these assets. So as I said before, fixed assets are long-term assets such as property, plant, and equipment. These assets depreciate over time. They physically exist and are called tangible. Remember, tangible, physically touch it. Intangible, cannot physically touch it. They're owned and used by the company in day-to-day operations, and they're not typically offered for sale as a normal part of those operations. In other words, the company is not involved in buying and selling property, plant, and equipment as its primary business. The primary business is to operate a factory to produce goods, not to be in the business of buying and selling stuff. Not in the business of buying and selling property, plant, and equipment. As you know, there are costs associated with pretty much everything we do in business, right? There are costs associated with the purchase, sale, maintenance, or anything else related to property, plant, and equipment. So there are costs incurred with the purchase, sale, maintenance of property, plant, and equipment. So let's discuss property, plant, and equipment as we go through steps in classifying the costs associated with them. So there are steps. In accounting, as you know, there are steps for everything that we do. Accounting is a very systematic process, a systematic process of the business. That's what accounting is. It is a system, okay? It is a system. And in this system, we have the accounting cycle that we talked about in the first few chapters of our course. And within that accounting cycle, there are steps that we have to follow in order to allocate costs, allocate income, so forth and so on. And what we're going to talk about now is how we classify costs for property, plant, and equipment. There are steps that we need to follow. The first step is to identify if the purchased item is what we call long-lived. In accounting, anything long-term, as you know, is greater than 1 year. Long-term, greater than 1 year. Long-lived means the asset that we are purchasing will last longer than 1 year. Long-lived. The asset will last longer than 1 year. Okay, that's long-lived. So an example, a personal example would be your house. Your house is a long-lived asset. We expect your house will last for 30 years or more. Okay? Your car is a long-lived asset. We expect your car to last 5 years or more.
One question, Professor.
Pavle, go ahead.
What if we bought a car and then after a few months we had an accident and then we don't have that car anymore?
It's still considered long-lived, but in that case, when something like that happens, then we have to expense it off of our books.
Okay.
But the expectation is that the asset is still long-lived. We expect the car to last for 5 years or more. If something happens in that first few months, then we expense it out and remove it from our books and then replace it with another long-lived asset.
Okay, thank you.
Good question. Absolutely. So if the purchased item is considered to be long-lived, it's recorded on the balance sheet as a fixed asset or an investment. We talked a little bit about this before. A fixed asset, as you know, is property, plant, and equipment that we use in the day-to-day operations of the business. If we are purchasing something and we plan to not use it in day-to-day operations of the business, we consider that to be an investment. An example, Let's say we have a factory, and on our underneath our factory is land. Okay, so we have, and in our factory we have equipment. Let's say the neighbor's land becomes available for sale, and for our factory we're expecting to expand. So I've decided that we're going to purchase our neighbor's land, but I don't know if we're actually going to expand or not. So if I decide to purchase my neighbor's land and not use it for the business right away, we classify that as an investment. Okay? Remember, here's the difference. Fixed asset means we use it everyday operations of the business. Property, plant, and equipment. We use that stuff for normal operations of the business. An investment is something that we purchase but is not used in the day-to-day business operations of the business. An example would be we expect to expand, we might not, we'll purchase the land anyway, and then if we decide not to expand, we could later sell it. So when we purchase an asset, if it's long-lived and it's yes, we record it on the balance sheet as a fixed asset or an investment. If not, then it's just an expense. In other words, if it's not long-lived. An example of that would be a computer that we expect to last for a year, or if it's a low-cost computer. It's still a computer is still an asset, but if we don't expect it to last long, then it's an expense. David, do you have a question?
Yes, I was going to ask you, what if it's a fixed asset? You purchase a fixed asset, but you're not using it every day, but it depreciates in value over time.
Yeah, so to clarify your question, David, so you have a fixed asset, you don't use it every day, but does it help you to generate revenue?
No.
The answer is it's an investment.
Investment. Okay. If it's not helping and generate revenue, no matter, okay, then it's an investment.
You got it. Yep. Because the idea behind a fixed asset, David, is a fixed asset helps the company to generate revenue, to make money. I use my property, I use my plant, I use my equipment to help me make money. If that is not true, then it's an investment.
Okay.
Good question. Absolutely. And if the answer is it's not a fixed asset or an investment, and we don't expect it to last long, we record it as an expense. Step 2. Is the asset used in normal operations? That's day-to-day operations of the business. Like we just talked about. Property, plant, and equipment we use to help us to generate revenue somehow. We record that as a fixed asset. If it is not used to help us to generate revenue, it's an investment. Just like David's question, if it's a fixed asset and it helps us generate revenue, it's a fixed asset. If it does not help us to generate revenue, it's an investment. Excellent question. Okay, so this is a nice graphical representation of that decision tree. Step 1, is it long-lived? If yes, you proceed to step 2. If no, it's an expense. Step 2, is it used in day-to-day operations? If yes, it's a fixed asset. If no, it's an investment. Decision trees. Oh, they're so fun. Okay. So it's just the 2 steps. Yep, nice and easy. Items that are classified or recorded as fixed assets include property, plant, and equipment. Remember, property, plant, and equipment, those are fixed assets and they are long-lived. They help us to generate revenue. And of course, we expect those things to last more than a year. And they're used in day-to-day operations of the business. Investments are long-lived assets we do not use in day-to-day operations, and we'll hold on to them for future sale. So in David, in your example, let's say you purchased a piece of equipment and like you said, it depreciates over time, and you plan to not use that piece of equipment, you could sell that piece of equipment, right? And that would also help to classify it as an investment. And these assets are reported on the balance sheet under investments. A couple of costs associated with the acquisition, meaning purchase of fixed assets, property, plant, equipment, and land improvements. To purchase a building or to build a building, we have architectural fees, engineering fees, insurance costs, interest on borrowed to finance the building, sales taxes, repairs, reconditioning, modification for use, permitting. All of these things are required for a building, to construct a building or to purchase a building. Here's the good news. I guess mostly good news. All of these costs that you see associated with each asset, when you go to purchase that asset, you add all of these costs together to equal what we call the initial cost of the fixed asset. The initial cost of the fixed asset is not just the purchase price. It's the purchase price plus all of these related expenses. That represents the initial cost of the asset. For machinery and equipment, it includes costs like sales tax, freight, installation, repairs, reconditioning, insurance, assembly, modification for use, testing, and permitting. For land, related costs include things like purchase price, sales tax, permits, brokerage commissions, titles, surveying, delinquent real estate taxes, removing unwanted buildings for salvage, or grading and leveling. Land improvements to help improve the property's value include things like trees and shrubs, fencing, outdoor lighting, paved parking lots, and walkways. Oh my, fun stuff, right? So, and we'll talk more about it. But to identify the total cost or the initial cost of your fixed asset is you take the purchase price plus all of the related expenses, or costs, I should say. Purchase price plus all of the related costs equal the initial cost of the asset. That's also called the book value of the asset. We'll talk more about it. So, what are the costs of fixed assets? So only costs necessary for preparing the fixed asset for use are included in the cost of the asset. So all of these things here, the building purchase price plus all of these things under building, all of those equal the cost, the initial cost of the building. All of these things added together equal the initial cost of machinery. All of these things are the initial cost of land plus land improvements. So those are what we call the initial costs, right? They're costs to get that fixed asset ready for use. There are other things that happen, okay, to assets. And we record these other things as expenses because they do not help to get the asset ready for use. These other things we call expenses. What can be expensed out in the initial cost? Vandalism, mistakes on installation. It's like, somebody came and installed a machine, they did it incorrectly, or somehow it broke during installation, got damaged during shipping, whatever, right? We can expense that out. I'll show you how to do it. Uninsured theft, damage during unpacking, fines not obtained for proper permits, been there, done that. There's a lot of types of expenses that happen. So, let me walk you through this example. It's a great example, in my opinion. And this example will help you to get a better understanding of how we identify the initial cost of equipment. And you could apply the same concept to buildings and to land. Okay. Okay. Our company purchased some equipment for $12,000. There was a freight cost of $600 to get the equipment to us. Okay. Then we had to get the thing installed. It cost $1,500 to get it installed. Then there was an error in the installation of $500, which happens sometimes. Okay, here we go. So, initial cost of the equipment, $12,500. Now, it's supposed to be $12,000. Let's pretend it's $12,500. $12,500 initial cost plus, let's say the $500 was in taxes. $12,500 plus $600 for the freight plus $1,500 for installation minus $500 for an installation error gets us at $13,600. So, interesting, right? So we see that we have the purchase price plus tax plus freight plus installation minus installation error gets us to our initial cost for the equipment of $13,600. And of course, for the journal entry that we would make, we debit equipment to increase equipment and credit cash to decrease cash. Any questions on how we got to $13,600? Does it make sense so far on how to find the original cost of the equipment?
Yes.
Right? Very good. So remember, purchase price plus freight plus installation minus any nonsense, right? Like errors or damage or whatever. Yep. Okay.
But that is only if they have like damage or something.
That's right,
If
Bob.
something.
Yeah. So the only time you would subtract from that original cost is if there was like damage or an error during installation, like in this example. That's right. Very good. Okay. Now continuing on this theme. Before we learned about direct costs and indirect costs, we'll talk more about that as we go forward. Direct costs incurred during construction. Okay, so shift gears a little bit in your mind. Think about like you're building a building, building a building. You're constructing a building. Okay, you're putting up a building. As you know, as you build a building or construct a building, there are costs associated with construction. Those costs get added up throughout the construction process, and those costs get allocated to an account called construction in progress. Construction in progress. As we are building a building or constructing a building, we add up all of the costs associated with that construction. Direct materials, direct labor, cost of acquisition, whatever. We add those things up and we debit those costs to construction in progress. Construction in progress. And we credit building, okay, because we're putting up a building. When the construction progress is complete, we reclassify those costs by debiting building, and crediting construction in progress. Okay. Construction in progress is one of those temporary accounts that we use temporarily as we're constructing a building. It's like a placeholder on the balance sheet, right? Okay. Now I want to talk to you about, we talked about costs associated with fixed assets. Now I want to talk to you about leasing fixed asset. As you know, a lease is an agreement between two parties for the use of an asset. Okay, a lease is an agreement between two parties for the use of an asset. For example, right now I'm renting an apartment. That is a lease. Rent is a lease. When you rent something, it is a lease. Okay, that is, the lease is the name of the agreement between you and the landlord to lease their asset. In this case, an apartment is the asset. So you agree to rent an apartment. Rent is lease. Okay, the lease is the agreement between you and the landlord. So the lessor is the landlord. That's the person who owns the apartment. The lessor is the person who owns the asset. The lessee, that's me. I'm the person renting the apartment. Okay? So I'm the lessee. My landlord is the lessor. Lessee is the person who's renting the apartment or using the asset. That's a lease. A couple advantages to leasing an asset. You don't have to go and get a loan. You don't have to do that when you lease. Okay, so there's no cost associated with getting a loan. Expenses like repairs and maintenance usually falls on the landlord or the lessor. I say usually because it's not the same in all cases, but most of the time it does. So like, for example, if my washing machine just goes up and takes a dive, I call the landlord. And the repairs and maintenance is on the landlord. Havle, did you have a question?
Yeah, about this. What about if company lease the, like, for example, car?
Mhm.
They're basically renting. Do you have like some benefits like on the taxes? Like
No, not on taxes, no. The only benefit to leasing a car is reduced maintenance costs. But that's really it. There's not a whole lot of advantages to leasing a car. It actually costs more to lease a car than it does to buy one over time. So, like, if you run out the calculation, let's say your lease payment is $400 a month, okay, and to purchase a car, it costs the same amount a month. The difference you'll find is going to be in the interest rate, okay, but technically, there's really no advantage to leasing a car, unless the company that you're leasing it from covers all repairs and maintenances, and there's no overage charges. That's the only time there's an advantage. Good question.
but so no, like if is it like company, but then you can like deduct your tax or something, because my accountant told me like
You can
do
expense it
that.
out. Yeah, you expense it out, which ultimately reduces your tax rate, but it doesn't depreciate in value. So if you bought the car for the company, you can depreciate it. But if you don't own it, you can't depreciate it. You see what I'm saying?
Yeah, because it's kind of basically renting. You don't own it. It's like
Exactly. Yep. So with a lease, you can deduct it in your taxes through the expenses of the business. Yes, you can do it that way, but you can't depreciate it. Your tax advantages would be better if you owned it because you could depreciate it. So that's another difference between leasing and owning. Yeah, good question. Very good question. Repairs and maintenance typically covered by the owner, the lessor. The risk of incurring additional costs of the asset becomes obsolete before the end of its useful life. What does that mean? So if Pavle is leasing his car for the company, his lease will be 2 to 3 years, typically 2 to 3 years. At the end of his lease, Pavle can turn his vehicle into the dealership and get another lease, therefore mitigating the risk of it becoming obsolete. The word obsolete means it's outdated. It's no longer really useful. Leasing is governed by the Financial Accounting Standards Board and the Internal Accounting Standards Board. They have developed ASC 306, 603, ASC 603, Accounting Standards 603. It's new. It's actually really new. This just came out in 2020. This is a rule in accounting that helps us to govern leases and how we expense leases out. No, interesting. Under different types of lease, we record it as expense. Depreciation is not recognized for a lease, as you know. It's recognized as interest expense if it's a lease. Short-term leases, we record these simply as expenses. A short-term lease, as you know, word short-term, 12 months or less. Short-term, 12 months or less. Long-term, more than 1 year. 12 months or less, short-term lease, it's a simple expense. An example of that would be you rent from your landlord year to year. That is a short-term lease. And therefore, you just record it as an expense. But regardless of the type of lease, it should always be disclosed in the notes on the financial statement. Okay, over time, fixed assets, with the exception of land, will depreciate. Land will never depreciate. The physical land, the dirt your house sits on will never depreciate in value.
Sir,
Yes, go ahead.
so sorry to cut you off. I've been trying to log into class for like 30 minutes. I try to use the Blackboard to enter, but I didn't know it was WebEx, so I just got in. I'm so sorry.
That's okay. I appreciate you being able to find us. So going forward, it's always going to be through Blackboard. So if you log into Blackboard, click on WebEx.
It didn't work for me through Blackboard.
It did not. Okay.
It did not. I have to go through the email and then to
Oh.
see the email you sent to be able to join the meeting.
Interesting. Okay. Well, thank you for letting me know that. I'll do me a favor. Send me an email and just kind of put that in a note so that way I can remember to fix it.
Okay. All right.
Thank you so much. Okay. So depreciation. Land, the physical land, the dirt will never depreciate in value. The reason why the land never depreciates in value is because land is considered to be infinite. Its useful life is forever. Okay, well, we like to believe that's the case. Land lasts forever. Okay, the actual dirt will be there forever, ideally. So in accounting, we consider land to be infinite. That's why we do not depreciate land. We do, however, depreciate other fixed assets like plant and equipment. The buildings, and the equipment that is inside those buildings will depreciate over time. The word depreciation means to reduce its value. The reason why we depreciate buildings and equipment is because over time they lose their useful life. For example, if I did nothing on my house, if I never did any repairs, what do you think is going to happen to it? It's going to lose its useful life. Okay? If I have a piece of equipment that I use to create, let's say I have a t-shirt company, okay, and I make t-shirts. I use a screen and I put the print on it, that's a fun business, by the way. It's a fun side business for some people. I think it's cool. I think it's very cool. Okay, so you have a t-shirt business. You make t-shirts. So you have a screen and you have a press. The press comes down, imprints the design on the shirt, and goes up. That piece of machinery depreciates over time. It uses its useful life. Why does that happen? Because over time, things become old and they don't work as well over time. Okay? Eventually it will stop working. Right? That's how equipment works. Your computers, your phones, your everything electronics, they don't last forever. Okay? So therefore equipment, which is high value equipment that we expect to use for many years, depreciates over time. Okay, because eventually it'll stop working. It's getting old. It'll become obsolete at some point. It has a definitive useful life. Definitive useful life. In other words, I know that my car will last 5 years. According to the government, it'll last 5 years. It'll probably last longer than that. But the useful life of a car is considered 5 years. Okay? We know cars last longer than 5 years. We know that. As long as you keep the maintenance going on it, it'll last forever. Okay? But will it last forever? Probably not. But it'll last longer than 5 years. The government has a schedule that they produce through the IRS that tells accountants how long things are supposed to last. Okay? Although we know that they're not always correct, we know that things have a useful life. Okay. So just remember, land never depreciates. The physical dirt will never depreciate. Depreciation is caused by physical or functional factors. Physical depreciation, wear and tear from weather exposure, or just from constant use, right? Functional depreciation, things will break over time. That's what this tells us. It will become obsolete. Customers will no longer like your t-shirt design. Things change over time. Yeah? And so that's called functional depreciation. There are a couple of misconceptions about depreciation. Depreciation is not the same as book value. Depreciation does not measure a decline in market value of an asset. Okay? For example, your house depreciates over time. The building itself does. Okay? Because it loses its useful life over time. However, we know, especially living in the DC region, we know that just because the house is depreciating over time does not mean the value depreciates over time. The value is actually opposite for housing, especially in the DC region. We know that the value of our houses continues to increase year over year because the market is very desirable. People want to move to DC. So the value of our homes increase over time, year to year. Although the house will depreciate over time because it gets older, things start to break down. Yeah? So the misconception is depreciation is not the same as market value. It's very different. So never think that depreciation and market value are the same thing. They're very different. Depreciation is an allocation to the fixed asset's cost and expense over its useful life. Book value of a fixed asset is the original cost of the asset minus accumulated depreciation. and it is usually never the same as market value. Book value is the original cost of the asset minus accumulated depreciation. Okay, that's book value. We'll talk more about it. Depreciation is also very important. Depreciation has nothing to do with cash. Depreciation has nothing to do with cash. You don't pay cash out when things get older. Okay? You don't pay when you depreciate an asset, you don't pay cash for depreciation. No. That's silly. Depreciation has nothing to do with cash. Okay, so now that we got past the misconceptions, let's talk about how do we depreciate an asset. Okay, there's a couple of methods. There's a couple of methods we can use to depreciate a fixed asset. The three most common ones, there's four common ones, but I'm going to talk about three of them right now. The three most common. Number one is called straight line depreciation. Straight line depreciation. Okay, that means we depreciate the same amount every year over the asset's useful life. We'll talk about it in detail here in a second. I just want to give you a heads up. Okay. The second most common is double declining balance depreciation. Double declining balance depreciation. The name implies that we double the depreciation in the first few years of its useful life. The third most common one is what we call depreciation based on units of production. We'll talk more about that as well. There's a few other ones, but those are the three most common. Okay, now let's walk how to depreciate an asset. The first thing you need to do is figure out the asset's initial cost. Remember, the initial cost is the purchase price plus delivery plus installation plus modifications minus any type of error or defect, damage, those types of things. That's the initial cost of the asset. Okay, that's step one. Step two, we got to figure out what is the expected useful life of our asset. Now, this part gets complicated. To uncomplicate it, the IRS, the Internal Revenue Service of the United States, has helped us accountants by creating this thing called a depreciation schedule. Depreciation schedule. And what that does, this depreciation schedule, it's a document that the IRS updates every year. And what that document tells us is the expected useful life of every asset. Okay? Whether that's a truck, a dump truck, a piece of equipment, a building, whatever. This schedule gives us a guideline of its useful life. Okay. So, step two, figure out what the expected useful life is of the asset. Step three, figure out the asset's estimated residual value. Okay. I can hear you already. What is residual value? Residual value is how much the asset is worth at the end of its useful life. Okay? So, for example, let's say I have a dump truck. And the dump truck I purchased for $25,000. The expected useful life of my dump truck is 4 years. If I use straight line depreciation, I would reduce the value of the dump truck by $5,000 until it reaches a value of 0. When it reaches a value of 0, the expectation is the truck is still worth something. Okay? It's probably worth what we call scrap value. Scrap value. It's basically what the value of the metal is, right? We'll talk more about it, but that's the idea behind residual value. So remember, step 1, figure out initial cost. That's the purchase price plus all of the related costs to obtain it. Purchase price plus installation plus delivery plus modifications minus any errors minus any defect. It's the cost of acquiring it plus getting it ready for use. Step 2, expected useful life. Figure it out. Okay, so again, like I said, the IRS typically tells us how long things are supposed to last. This is an estimation of how long it will be used in day-to-day operations of the business. I expect my dump truck to last me for 4 years. Okay. How do I get 4 years? It's based off the IRS's schedule. But I also estimate I'll be able to use that dump truck in the business for 4 years. It's estimated at the time it's placed into service. Okay. What do I mean by that? Let's say I purchased a dump truck in October, but I don't plan on using it until January. I would start estimating its useful life starting in January. Okay? Because that's when I start to use it. Estimates of the expected useful lives are available from industry trade associations and the IRS. It's actually better to get it from the IRS. The reason being is because depreciation, as you will find out, is deductible in taxes for businesses. Okay, residual value is step 3. Residual value of a fixed asset is the estimated value at the end of its useful life. It's estimated at the time the asset was placed into service. Residual value is also known as scrap value, salvage value, or trade-in value. That is the same. All of those 3 terms are the same as residual value. Residual value is scrap value, salvage value, or trade-in value. The word trade-in value, you've probably heard that before. If you ever owned a car, a vehicle, and you wanted to trade it in for a newer vehicle, that is called residual value. Okay. Here we go. Depreciation. The difference between a fixed asset's initial cost and its residual value is called the asset's depreciable cost. Depreciable cost. In other words, that's the amount I can depreciate over time. So, depreciable cost equals initial cost minus residual value. Depreciable cost equals initial cost minus residual value. That's how much I can depreciate over time. And we allocate this cost over the useful life of the asset. Fixed asset has no residual value. In that case, the entire amount of the initial cost of the asset should be allocated to depreciation. Ready for the example? Okay. Let's say our company purchased a new forklift. Okay, and we put it into service on January 1st. The forklift cost the company $24,000. The expected useful life is 5 years. expect to be able to use our forklift for 5 years. The residual value is $2,000. How much, if I were to use straight line depreciation, how much can I depreciate my forklift per year? Who can tell me? What's the answer? Any guesses? How much can I depreciate my forklift each year?
Is it 5 years?
5 years. It's good for 5 years. So what's the value per year that I can depreciate this forklift?
$2,000?
Let's find out. Okay, so I got my calculator here. So remember the formula
Yeah, fella.
is initial cost, 24,000.
Go. Yes, can you hear me?
Yeah, I can hear you. We can hear you.
I think that was an accident, Professor.
Oh, okay, no worries. So the initial cost, I just realized I didn't have my microphone real close to me. I hope you guys were able to hear me the whole time though, right?
Yes. No problem.
Was it loud and clear?
Yes.
Okay, that's good. Okay, got my calculator here. So here's how the formula works. You take your initial cost minus the estimated residual value, $2,000. Okay, that equals 22,000. Now you divide that 22,000 by 5 years. That gets us to $4,400 per year for 5 years. That's how much we would depreciate this forklift using straight line depreciation. Let me show you. Okay, here it is. Initial cost minus residual value equals the depreciable cost. So 24,000 initial cost minus residual value 2,000 equals 22,000 depreciable cost. You divide this depreciable cost over the 5 years of its useful life to get us to $4,400 per year. Year one, at the end of year one, my depreciation is $4,400. End of year two, another $4,400. End of year three, $4,400. You add them all together at the end of year 5 to get to 22,000. That's straight line, and we'll talk to you more about it. But I just want to give you an idea of how we depreciate our asset. Any question?
Yes, I have a question. But what if we have like in a year two, like something to fix on that?
Good question. Good question. Okay, so now here's the thing with repairs and maintenance. I'm going to need to change the oil on this forklift every year, okay? I'm going to need to replace the tires probably every year. I'm going to need to do other maintenance stuff to this thing. That's just a simple expense. Repairs, you debit repairs and maintenance expense, and you credit cash. You're just simply expensing it out on your income statement. Now, if it's a major repair, we're talking replace the engine, okay? Or replace part of the forklift itself. That's a major repair. What that does is it actually improves its useful life. And you would have to then recalculate its useful life. Good question. Very good question. So in other words, it depends on the type of repairs and maintenance. Excellent question.
Thank you.
Yep. And we'll talk a little bit about that too. Okay, so as I said, there are 3 methods of depreciation. First one is straight line depreciation. That's where we depreciate the same amount every year over its useful life. The second most common is units of activity. Units of activity. What this is that I can estimate the number of units I will create using the asset over its useful life. We'll talk more about it. And the double declining balance depreciation. This is where I take double the amount of the depreciation for the first year and then subsequent years. We'll talk about that calculation as well. Double declining balance depreciation is calculated using the straight line depreciation percentage. We'll talk about that. It is not necessary for a company to only use one method. Okay, here's what we mean by this. Let's say you have a construction company, okay? And you have a forklift, you have a dump truck, you have a backhoe, you have a steamroller, whatever, okay? You have 4 different pieces of equipment. You don't just have to use one of these methods for all of them. You can actually use different methods. So here's how it works. You select one method for each asset. For the dump truck, I'm going to use straight line. For the forklift, I'm going to use units of activity. For the steamroller, I'm going to use double declining balance, so forth and so on, right? So in other words, you don't have to use the same method for all of your fixed assets. You can use different methods, but you have to use one method per asset. That's what that means. Let's talk about straight line. The straight line method provides the same amount of depreciation expense per year for each year of the useful asset. So going back to my example, oh, look at that, I was right on. Okay, so remember our forklift, the initial cost was $24,000. Residual value was $2,000, useful life of 5 years. To figure out the annual depreciation amount, you take your initial cost minus residual value divided by 5 years. So initial cost, $24,000 minus $2,000 residual value, that's $22,000. Divided by 5 years, $22,000 divided by 5 equals $4,400 per year of depreciation. And we do that for 5 years. So 4,400 plus 4,400 plus 4,400, so forth, so on, until it reaches a value of 22,000. Make sense?
Yes.
Wonderful.
Yes.
Excellent. So, now, looking back at our pictorial graph here. Initial cost, $24,000 minus $2,000 residual value equals depreciable cost, $22,000 divided by 5 years, that's $4,400. Now, the last step I need to do is figure out my straight line rate. The rate tells me the percentage of the depreciation per year. In our case, it's 20%. How did we get 20%, you might ask? Well, you take your 4,400 that you got from our earlier calculation for straight line, and you simply divide that by the initial cost, 24,000. Well, actually, I'm sorry. By the 22,000, 4,400 divided by 22,000 equals 20%. So you take your depreciable cost, you take your depreciation expense divided by your depreciable cost to get to your percentage, okay, straight line rate percentage. In this case, it's 20%. 20% plus 20% plus 20% plus 20% plus 20% equals 100% over the 5 years. Does that make sense? How we're able to calculate the straight line rate, the percentage. Everyone understands how we do that, how we get 20% per year. Yeah? Okay. Now, okay. Here's another method of figuring out the 20%. You take 100 divided by its useful life. 100 divided by its useful life will give you the percentage. So, which is probably a simpler way to do it. What I just showed you earlier is the mathematical way to do it. All you're doing is you're taking depreciable cost, depreciation expense per year divided by depreciable cost. Another way to do it, to figure out the straight line percentage, is you take 100 divided by the useful life. In this case, 100 divided by 5, guess what? It's 20%. So that's a simple way to do it. What is the journal entry we make at the end of each year to represent depreciation? So, to depreciate using straight line method, we debit depreciation expense and we credit accumulated depreciation. Now you see here in the journal entry, it says depreciation expense forklift. That is to help us to identify which fixed asset we are depreciating. Especially if a company has more than one fixed asset, it's good to know which one it is. It's very important that you know which one it is. So, as we mentioned, the depreciation expense is $4,400 per year. So at the end of the first year, depreciation expense $4,400, accumulated depreciation $4,400. I make this same exact journal entry for each year for 5 years. Okay. Here's how the accumulated depreciation works. Accumulated depreciation shows up as a minus or a negative sign on your balance sheet under fixed assets. Accumulated depreciation is a minus under fixed assets on your balance sheet. The reason being is because on our balance sheet, we have a list of our assets, right? Under assets, we have a list of our assets. You got cash, accounts receivable, inventory. Those are your current assets. Then you have your fixed assets, property, plant, and equipment. And under property, plant, and equipment, you have accumulated depreciation for property, plant, and equipment. Okay? The accumulated depreciation is a running tally. It adds up all of the depreciation over time. Because your fixed asset on your balance sheet will always represent the initial cost. So on my balance sheet, I have forklift, $24,000. Underneath that, I have accumulated depreciation, forklift, minus $4,400 is the balance at the end of that first year. So we never do anything to the original cost. The original cost always will be the same. The accumulated depreciation is what we're continually adding on to reflect the depreciation of that fixed asset. Earlier we talked about this thing called book value. Book value is a difference between the original purchase price, or the original cost, initial cost of the fixed asset and the accumulated depreciation. So to figure out book value, what you do is you take the cost of the equipment minus accumulated depreciation equals book value. Questions? It's pretty much the end of straight line. Everyone understands straight line depreciation now? Kind of, sort of, mostly? Yes?
Yes, sir.
Great. Thanks, Mike. Appreciate it. Okay, nice graphical representation. My forklift depreciates every year, 4,400. That's straight line. The book value. Remember, book value represents the value of the asset. At the end of the first year, it's 19,600. That's how much my forklift is worth at the end of the first year. Then, at the end of the second year, it's worth 15,200. How did we get there, you might be asking? Now remember, initial cost of the asset minus the depreciation. Then we take that amount, book value, minus depreciation to get 15,200. Then minus depreciation to get to 10,800. So forth and so on.
So you're doing it the same way to get the same answer, you just recording it differently?
No. So,
Best. Go ahead, answer a question. Go ahead.
Natisha, can you rephrase that question?
So like you see how like it go across and it's 4,400. So it's showing how much is taken away from it each year versus book value. It shows how much it's worth each year.
That's correct. Yep, absolutely. So every year I depreciate $4,400. The initial cost of the forklift was $24,000. 24,000 minus 4,400 is 19,600. Then 19,600 minus 4,400 is 15,200. 15,200 minus 4,400 is 10,800. 10,800 minus 4,400 is 6,400. 6,400 minus 4,400 is 2,000. We see at the end of year 5, it's the forklift is worth $2,000. That is the same as the residual value. David, go ahead.
I was going to ask you, how was it like? How did you get the 44?
The 4,400?
Yes.
Yeah, so that is the depreciation expense per year using the straight line method. You take the initial cost minus the initial cost minus residual value divided by the useful life. So initial cost was 24,000 minus the residual value of 2,000. That gets you to 22,000. Divided by the useful life is 5 years. So 22,000 divided by 5 is 4,400. Does that help to answer your question, David? Great. Thank you. Good question. Okay, so that's straight line. Now let's move on to the next method of depreciation called units of activity. Units of activity. This provides the same amount of depreciation for each unit of activity of the asset. It depends on the asset and the units of activity expressed in terms of hours, miles driven, or quantity produced. Units of activity is also called units of production or units of output. They all mean the same thing. You know how us accountants like to use the same different word for the same meaning, right? So you have units of activity is the same as units of production or units of output. Here are the steps we take to figure out the units of activity. Number 1, we determine the depreciation per unit. Per unit. Okay. Take our cost minus residual value divided by total estimated units of activity. Now, how do we figure that part out? Let's look at our forklift. Our forklift cost $24,000. Residual value is $2,000. So call 24,000 minus 22,000 is I'm sorry. 24,000 minus 2,000 equals 22,000. That's the top part of our equation. The bottom part says total estimated units of activity. We have to figure that out. That's going to be given to you, okay? In our case, it'll be the number of hours that the forklift will be driven. Number of hours that the forklift will be driven or used. Because with forklifts, instead of odometers like you have in your car, we don't measure forklifts by miles, we measure them by hours. Just like a lawnmower. A lawnmower has an odometer on it. The odometer is number of hours, not miles driven. Okay, so that's step one. Step two is we compute the depreciation expense by taking the depreciation per unit, which you got from step one. We multiply that by the units of activity for the period. Let's look at our example, okay? Now remember, we have a forklift. It costs us $24,000. We have a residual value of that forklift of $2,000. We expect that we will use our forklift for a total of 10,000 hours over its useful life. Okay? It's pretty good. That's good usage. So we know that we were expect to utilize our forklift for 10,000 hours. So we take the first step. Remember, the first step is determine the depreciation per hour. So cost minus residual value. 24,000 minus 2,000 is 22,000. Divided by the estimated units of activity. The estimated units of activity is the useful life expressed as an activity. In this case, it's 10,000 hours is how long I plan to use, or the expected useful life of my forklift expressed in hours. It's 10,000 hours. So 22,000 divided by 10,000 is $2.20 per hour. So step one, we figured out depreciation per hour, $2.20. Everyone sees this first step? It makes sense so far, right? Yes? Okay. Michael, you good, right?
Yes, sir. Yes, sir.
Awesome. Thank you. So $2.20 per hour. Then step two, I take my depreciation per unit times the units of activity for the period. So what it says, during the first year, the forklift was operated 2,100 hours. So I take my $2.20 per hour, and I multiply that by the 2,100 hours I utilized in the first year. So $2.20 times number of hours used, $2.20 times 2,100 equals 4,620. 4,620 is the amount of depreciation for the first year for the forklift. You see that it's different. It's different than straight line. It's a different method. So if it's a different method, you're going to get a different result. 4,400 was straight line. 4,620 is the first year for units of activity. So what is the journal entry we make at the end of the first year? It's very similar, right? We debit depreciation expense, 4,620, and we credit accumulated depreciation, 4,620. as we said earlier, the useful life of the forklift is 5 years. We expect that we'll be able to use the forklift for 10,000 total hours. In the first year, we used 2,100 hours. In the second year, we expect to use it for 1,500. Third year, 2,600. Fourth year, 1,800. Fifth year, 2,000 hours. You add all those up to get to 10,000. Now, you're probably asking, how did you figure all of these different years? These are the years these are the number of hours we actually used the forklift in each year. So, here's how it looks. Remember, we got the initial cost, $24,000, minus residual value, $2,000. That's $22,000 depreciable cost. We took. What did we do? We took our $22,000 divided by the number of hours of its useful life, 10,000 hours. So 22,000 divided by 10,000 hours got us to $2.20 per hour. In the first year, I used the forklift for 2,100 hours. So $2.20 times 2,100 got us to $4,620 for that first year. The second year, I used it for 1,500 hours. $2.20 times 1,500 equals $3,300. And so forth and so on. You do the same calculation for each year to figure out the depreciation for each year. We know it's going to be different for each year because we're using it, the forklift, for a different number of hours each year. And so what do? You record the transaction at the end of each year. You debit depreciation expense, credit accumulated depreciation, and then we can also figure out the book value at the end of each year. So remember, book value, $24,000 minus the depreciation amount. Initial cost minus the depreciation amount gets you to book value for each year. And then we end year 5 with 2,000. Why do we end year 5 with 2,000? Because we expect residual value of 2,000. Questions so far? Does units of activity make sense?
One question, but what if that bring us money? If is that something that we can make money with that? With this forklift?
Oh yeah, absolutely. Yeah, the forklift is a useful asset. It is a fixed asset that helps us to generate revenue. How does it help us to generate revenue, you might ask? Let's say your company has a warehouse that you use to hold your products for sale, okay? And you need to ship those products when you sell them. So you use your forklift in your warehouse to get pallets down and get it onto the truck. It is a part of the process of selling indirectly, which is the reason why the forklift helps you to generate revenue. Does that make sense?
Yes.
Great. Perfect. Good question. Any other questions on units of activity before we proceed to double declining balance method? I know it's letting it sink in. I know it's a lot of information. Okay. Units of activity is typically the trickiest one. It's usually the most complicated for students to calculate. That's why I want to make sure that you understand those steps and the formulas involved with each step. You'll find it on the homework, just so you know. Okay. Moving on, double declining balance. Double declining balance provides exactly what it says. We double decline at the beginning of its useful life. Declining periodic expense over expected useful life. I'll show you how it works. Okay, there's a couple of steps here. The first step, determine straight line percentage using the straight line method. We learned about that, remember? So in our forklift example, our straight line percentage is 20%. How did we get there? You take 100 divided by the useful life. In our example, the forklift useful life is 5 years. 100 divided by 5 is 20%. Yep. So that's step one. Step two, determine the double declining balance rate by multiplying the straight line rate by 2. So 20%, so step two, we take the 20% and we multiply that by 2. Guess what? That results in 40%. 20% times 2 is 40%. 20 times 2 is 40. So that's step two. Step three, compute the depreciation expense by multiplying the double declining balance rate that we got from step two, that's 40%, times the book value of the asset. Now you know, book value of the asset is your initial cost minus the depreciation. So initial cost minus the depreciation times the 40%. So how does it work? How does it look? Okay. Our forklift cost $24,000. Expected useful life, 5 years. Residual value, $2,000. Straight line percentage is 20%. You take 100% divided by useful life, 5 years. That's 20%. Step two, figure out the double declining balance rate. You take your 20%, you simply multiply it by 2. In this case, it's 40%. Step three, figure out your depreciation expense. You take your $24,000, that's your initial cost, times your double declining balance rate. Initial cost times double declining balance rate. In our example, $24,000 times 40% is $9,600. And that is the amount that we allocate for depreciation expense for that first year. And of course, the journal entry, debit depreciation expense, $9,600. Credit accumulated depreciation, $9,600. It's all about following the steps. If you remember the steps and follow the steps, you will do very well with calculating depreciation for any method. It's all about the steps. All about the steps. It's all about the steps. Okay, now let's look at it for the 5 years. Initial cost, $24,000 times 40% equals times 40% is $9,600. What's the book value at the end of year one? You take your cost minus the depreciation for the year. In this case, $9,600. $24,000 minus $9,600 is $14,400 is the book value at the end of year one. Then what do? End of year two, you take your $14,400. That's the book value, right? Times the 40%. Depreciation for the second year is $5,760. $14,400 minus $5,760 to get to $8,640 book value at the end of year two. And you take that amount For year 3, 8,640 book value times 40%. You see what we're doing here, right? Then we get to year 5, and the year 5 remaining book value is 2,000, which is also the same as the residual value. Whew, that one's a long one. Okay. When the double declining balance method is used, the estimate of the residual value is not considered. However, the asset should not be depreciated below the estimated residual value. In other words, you realize at the very beginning, we did not take into consideration residual value. We just went straight 24,000 instead of the 22. The reason for that is because double declining balance does not take into consideration the residual value. However, at the end of the useful life, at the end of year 5, we should remain with the residual value. That's what this top part is telling us. Double declining method was higher depreciation in the first year, which is why we call it double declining. This is also called accelerated depreciation method. That's another word for it. And here's a graphical representation of it. 24,000 minus 2 is 22,000 depreciable cost. You take your initial cost, 24,000, times the double declining balance rate, 40%. You get to 9,600 for the first year. Take your book, you get your book value minus your depreciation from year 1 to get the depreciation expense for year 2, so forth and so on. Any questions on double declining balance method? Makes sense, right? Remember, it's all about following the steps. If you follow the steps, I promise you'll do very well. Look at the steps, memorize the steps, follow the steps. You'll get it, I promise. You'll get it. Good so far? Okay. I'm trusting y'all. All right. Let's look at the 3 methods side by side. Straight line, as you know, is 100% divided by useful life. Straight line's very easy. It's the simplest one, right? You take cost minus residual value divided by number of years. That's your straight line rate. Straight line cost. Straight line rate, you take 100% divided by its useful life. And our example is 20%. It's consistent, easy to use. Units of activity, it's based off of the units of activity. In our example, 10,000 hours, right, of activity. Double declining balance, it's straight line times 2, right? And then you take your book value minus. Yeah. So that's a nice comparison of the 3. And this is also a comparison of the 3 methods. Very, very simple. The reason why a company might use double declining balance over straight line or units of activity is because companies have the ability to deduct depreciation in their expenses for taxes, right? Because remember, accumulated depreciation is a minus for the assets. The less assets the company has, the more ability the company has to deduct it from their taxes. That's why double declining balance is very useful for companies. What happens in a partial year? Let's say I purchased my forklift in June. Okay, that's halfway through the year. I would still need to depreciate that first year by 6 months. So all you do, it's very easy. You figure out what the depreciation is per month. Okay, we're talking about partial years, figure out what the depreciation is per month. And then you simply depreciate by the number of months that you used it during that year. That's partial year. It's very, very simple. So in our example, let's say I purchased the forklift in October, or I started using it in October. So that's 3 months of use. I know that the depreciation is $4,400 per year, but for that first year, it's only $1,100. How did I get that? 4,400 times 3 divided by 12. Or you can simply do 3 divided by 12 is the percentage of the year that I used it, right? So if I only use it for 3 months, I'm going to only allocate it for 3 months. That's the idea behind partial years. For units of activity, it's the same concept. How many hours did you use the forklift for those 3 months? $2.20 per hour times the number of hours you used. That's the depreciation for that first year. Same with double declining balance. Right? It's very straightforward. Okay. Revising depreciation estimates. Earlier, Pavle asked a question. The question was, what if I make a major repair? For example, if I replace the engine in my forklift, I am essentially extending the useful life of that forklift. And so therefore, I will need to revise my depreciation estimates for those future years. Here's an example. I have a machine that costs $140,000. The expected useful life is 5 years. Estimated residual value is $10,000, and I use straight line. Straight line gives me $26,000 per year. That's initial cost minus the residual value divided by useful life. Now, let's say, so I figure out my book value. 140,000 minus 52,000 for 2 years. So this is the end of year 2. Let's say I end up replacing something to extend the useful life. I then have to revise my residual value. That's basically what that tells us. Repairs and improvements, they're expensed out. So repairs, I changed the oil on the forklift. I put new tires on it. That type of stuff. Those are expenses. Those are simply expenses. They do not, just changing the oil is not going to extend the useful life. That's just regular maintenance. Yep. So we just expense that out. But if it's a major repair that does extend the useful life, we call that a capital expenditure. Capital expenditure means I extend the useful life. Otherwise, it's just an expense. Example of expense. I gave a delivery truck a tune-up. It cost $300. Debit, repairs and maintenance expense, and credit cash. It shows up in an expense on the income statement. Extraordinary repairs. The engine dies. Got to replace it. That's an extraordinary repair, and it's very expensive. So I allocated this to what we call capital expenditures. Capital expenditures will have an effect on depreciation. And this effect basically reverses some of the accumulated depreciation. To reverse accumulated depreciation, you debit accumulated depreciation in credit cash. This is a representation of extending the useful life of the asset. It's rare, but it happens. Yep. Asset improvements. I can make other improvements to the forklift by installing like a new hydraulic lift for it. Yep. When you improve an asset, you make modifications to an asset, you're improving the value of that asset. And when you do that, you need to increase that asset. So in this case, a delivery truck, I put a new hydraulic lift on it that cost $5,500. That's a $5,500 improvement to the truck. So I debit delivery truck to increase its value and credit cash to reduce my cash to pay for the hydraulic lift. So because the delivery truck has increased, its depreciation will also change over its useful life. Of course, there's benefits to doing that. We're getting there, almost done. A fixed asset is no longer useful and it has no residual life. We simply throw out the asset. Okay. In other words, we just remove it from our books. At the end of its useful life, if it has no residual value, we simply remove it from our books at the end of its useful life. And to do that, you just create a reversing entry at the end of its useful life. The reversing entry looks like this. You debit accumulated depreciation and you credit equipment. What this does is it removes the equipment from your accounting. And you do that at the end of its useful life and it has no residual value. If it has residual value, the value just simply represents the residual value and that's it. And it stays on there until you sell it or dispose of it. If it has not been fully depreciated, you should record the asset before removing it from the accounting records. How do you do that? You debit depreciation expense, credit accumulated depreciation for its remaining balance. Now, if the asset is a loss, meaning something happened to it, the forklift was expected to last for 5 years. It only ended up lasting for 4, for whatever reason, or 4.5 years, okay? It just gave out on us. And we're like, oh, you know what? We're just going to get rid of it. So we have to record a loss on that asset. So you debit accumulated depreciation, debit the loss on the disposal of the equipment, and you credit equipment to remove it. Sometimes you might sell a fixed asset in business before it's over with. And so to do that, you take the sales price minus book value to record that loss. And just like before, you would debit depreciation expense, credit accumulated depreciation to record the depreciation on the equipment that you sold. You still have to record the depreciation even if you sell it. When you sell a piece of equipment, you debit the cash, which is the sales price of the equipment. You debit accumulated depreciation to remove the depreciation from your books, and you credit the original cost of the equipment. Okay. What about natural resources? Like I said earlier, land never depreciates. Things that we call natural resources are naturally occurring in nature. We typically don't remove land for sale. Yeah, this is kind of like nice to know. What about depletion? Depletion's interesting. Some companies, their job is to deplete land resources. For example, a company grows and cuts down trees for paper, okay, or for lumber. In that case, they have what they call a depletion expense. And just like before, there's a couple of steps you need to follow for depletion. Step one, we figure out the depletion rate. You take the cost of the resource, divide it by the estimated units of the resource. In other words, how many pages I can get out of the tree. David, go ahead. Do you have a question?
Um,
It's my baby hair and the baby hair.
Professor.
David, go ahead.
Yes. My question, you have went on a little bit, but my question was back when I'm only lost a little bit on how to get the book value or something.
Yep, book value. So to get book value of your asset, to get the book value, you take accumulated depreciation, or I'm sorry, you take the book value. I'm trying to find which part. Just so, okay, here you go. The book value. Book value is found by taking the initial cost minus accumulated depreciation equals book value.
Okay, so based on how much you use of it.
Exactly.
All
That's
right.
exactly right. Yep, that's the best way to think about it. I couldn't have said it better myself.
Okay, so like this, say some cost 140,000 and have a life value of 5 years. You divide that 140 by 5 years, and say you use a year worth. That's how much, whatever it costs for that year, you subtract from.
You got it.
Cost.
You got it. Exactly right. So the book value at the end of year one would be 140,000 minus 14,000, or yeah, no, I'm sorry, 140,000 minus 26,000 would equal the book value at the end of year one.
Okay.
And then it would be whatever that book value is minus another 26 would equal the book value at the end of year two, so forth and so on.
Okay.
Does it make sense?
Yeah.
There was another slide I thought kind of depicted that pretty good. Let me see. Oh, here it is. Yeah. So David, if you look at this slide,
Right.
this was back in the double declining, but the concept's still the same, right? So initial cost, minus depreciation for that year equals book value. Then you take, for the second year, you go book value minus depreciation equals end of year book value.
Right. Okay.
Then you take that book value minus depreciation equals end of year book value for that third year.
So that would be, say, for something that costs 24,000 beginning with a 5-year life value. Okay, 24,000 divided by 5 will be 9,600 a year depreciation value a year. Okay.
You got it. Yep. Same concept.
No, I thought that's what it was, but it was just a little confusing looking at the board.
I know. Yeah. It gets a little muddy on some of these slides, especially when we're talking about partial years, but it works the same exact way. The only difference is with partial years, you're dividing it by the number of months that you used it instead of years. Right. Same concept. Let's see. Talking about discarding, selling. Natural resources. I'm going to beat up that one too much. Okay. Depletion rate. Cost of the resource divided by estimated total units of the resource. Step 2, depletion rate times the quantity removed. So an example of this would be a company that specializes in creating lumber. So how do you create lumber? You cut down a bunch of trees, you process those trees into wood, right? Into lumber. And so that's one example. Another company, this company's getting minerals out of the earth. Minerals do not replenish themselves. It's a finite resource that the earth provides. So cost of the deposit, how much we estimate to get out of it, and the number of tons mined during the year. So cost of the resource 400,000 divided by a million tons that we expect to get out of the earth total is 40 cents per ton. 40 cents per ton times the number of tons for that year gets you your depletion expense for the year. Again, very similar to other methods of depreciation. This is for natural resources. You don't have to worry too much about that. Intangible assets, as I said earlier, these are things you cannot touch. You cannot. Tangible means you could physically touch it. Intangible means I cannot physically touch it. Example of that would be patents, copyrights, trademarks, goodwill, music, art. Things you cannot physically touch. Accounting for intangible assets, what we do is we take the initial cost, how much it costs to create that intangible asset. For example, if I create a design and I want that design to be patented, the patent cost is the initial cost, plus lawyers' fees, plus filing fees, plus whatever other fees, right? That's my initial cost of a patent. And what do we do over time? We amortize that expense. When you amortize an expense, what you're doing is you're spreading it over time, right? Manufacturers will acquire products to sell through patents. The government issues a patent. Patents usually last for about 20 years. And then you have to either renew that patent or give up the patent. The initial cost of a patent is the purchase price plus legal fees plus any other fees incurred. That is the initial cost of the asset, in this case a patent. And then, of course, we expense that over its useful life through the legal fees, just like you normally would. Patent lasts 25 years. You simply take that initial cost divided by the number of years. So patent costs us $100,000 divided by the 5 years is $20,000 per year. So on. Same concept applies with copyright materials and trademarks. Initial cost plus legal fees plus all that good stuff, that's your initial cost. Goodwill. Goodwill is an intangible asset that's created by this, it's a weird term, but desirability. Here's how it works. Goodwill. Let's say you have a company and your company acquired or purchased another company, okay? The amount of that purchase price is called goodwill. Goodwill. And the reason why we call it goodwill is because you're buying the quality, reputation, and management skill. Again, this is an intangible asset. You can't physically touch goodwill. So we're really not going to get too deep into that type of stuff.
Hey, Professor.
Yeah, go ahead.
When you say patent, say like you get like a certificate or something to show like that you have a patent, would that make it intangible?
It's still intangible because I can't physically touch the idea.
Okay.
I can't physically touch the design.
So even if you have something to show that you do have it, it's still intangible.
That's right, yeah, because, I mean, although I can physically touch that piece of paper, I cannot physically touch the design.
Okay.
Make sense? It's the same way with like a record label. I can, or a copyright. I can physically touch the product. I can physically touch the copyright. But I can't physically touch the copyright. You see what I'm saying?
Yeah.
Yeah.
All right.
Yeah, it's still intangible. I can't physically touch the idea, right? That's the idea behind it. On the financial reports, it works the same exact way. They're still assets, so therefore we still debit. They still carry a debit balance. Okay, a couple of quick ratios I want you to kind of understand. one's called the fixed asset turnover ratio. What this does is it tells us how quickly I am using my assets to turn my assets into sales dollars. How quickly I'm using my assets to turn it into sales dollars. So I use my forklift to help me to create sales. How do I figure out how much that forklift is helping me? Is through the fixed asset turnover ratio. I take total sales, which you find on your income statement, divided by average book value of fixed assets. We know what book value is. It's the initial cost minus the accumulated depreciation. Initial cost minus accumulated depreciation is book value. So if I take the average book value, add up all your book values, divide by the number of fixed assets to get you to your fixed asset turnover ratio. Higher the better is what they say. So sales divided by average fixed assets. Sales divided by average. How do we figure out average fixed assets? Take your beginning of the year plus end of year, divide by 2. Beginning of the year plus the end of the year, divided by 2. Let's get you your average, right? So, okay, that got us to the end of chapter 9. Now let's jump into chapter 10 and cover that as quickly as we humanly can. The idea is we got to have this wrapped up by 1:30. So we're going to jam through it. It's not very difficult to understand the concept of liabilities. We've already discussed a lot of liabilities throughout the past several chapters. I'm going to touch on the most important concepts. So stand by. Stop this recording and start a new one.